The next set of ratios is profitability ratios. It is divided into 4, that is based on the sales, based on the assets or investments, based on the owner's point of view, and based on the market value or investors. So the first is based on sales. This is gross profit ratio, net profit ratio, operating profit ratio, and expenses ratio. The next is based on the assets. ROI is return on investment, return on assets, return on capital employed, and return on equity. And the next set is owner's point of view, earnings per share, dividend per share, and dividend payout ratio. And the next set is for market or valuation or for investors. Price earning ratio, dividend earning and yield ratio, dividend and earning yield ratio, market value or book value per share, and Q ratio. We'll discuss this in detail. This is gross profit ratio. Gross profit divided by sales into 100. All the profits will be in the numerator and the sales will be in the denominator. Net profit, so net profit in the numerator, sales in the denominator into 100. In this net profit ratio, you can use this or EAT, earnings after tax divided by sales into 100. If it is for the pre-tax, this is for after tax, and if it is for the pre-tax, earnings before tax divided by sales into 100. The next is operating ratio, operating profit ratio, operating profit divided by sales into 100, or EBIT divided by sales into 100. To find this operating profit, we'll use this formula. Sales minus COGS minus expenses will be the operating profit. The next set of ratio is for the expense ratio. COGS ratio, cost of goods sales ratio, COGS divided by sales into 100. Operating expense ratio, admin expense, selling and distribution expense divided by sales into 100, because operating will be only to the admin and selling and distribution overheads. Next is operating ratio, COGS plus operating expense divided by sales into 100. Finance expense ratio, financial expenses divided by sales into 100. So in this financial expense, it excludes the tax, loss due to theft, and goods destroyed by fire. These are all based on the sales. Now it is based on the investments or assets. Rate of investment is equal to returns, profits, earnings divided by investment into 100. Or you can use this formula. Same thing, returns, profit, earnings divided by sales into sales divided by investment. Sales and sales will get cancelled. Returns, profits, earnings divided by investment will be there. The profitability ratio, same thing, divided by sales. Investment turnover ratio, sales divided by investments. Whenever turnover comes, turnover will be in the numerator, that is sales, and divided by investment. This is on the part of the investment. Now on the assets. So it is calculated on the profit. Let it be, on the total assets, average total assets, or tangible assets, or average fixed assets. Total assets, tangible assets, fixed assets. And the numerator will be same, net profit after tax divided by average total assets, average tangible assets, average fixed assets. And here the net profit is exclusive of the interest. If it is exclusive of the interest, if at all the assets is borrowed through the through a financed lender, then you have to calculate like this: net profit after tax divided plus interest paid on the financed lease or financed asset, okay, divided by same thing, total assets, average total assets, average tangible assets, average fixed assets. Or you can also do like this: EBIT into 1 minus T here is tax, divided by average total assets. This is also called as ROTA, return on total assets. Then if it is on the net assets, same formula, but in the place of total assets you will write the net assets. It is also called as RONA, return on net assets. These are on the assets part. Then we will see the capital employed. Returns on capital employed of the pre-tax basis. Pre-tax EBIT, earnings before interest and tax divided by capital employed into 100. So to find out this capital employed, I'll tell you what formula you have to use. Next, ROCE, returns on capital employed post tax. So EBIT minus 1 into 1 minus T, tax divided by capital employed into 100. Or you can also use, this will be net profit after tax or net earnings after tax. Both are same. This is profit or earnings. Plus interest, this is plus interest divided by capital employed into 100. So I told you how to I'll say that how to calculate capital employed. You have to calculate like this: total assets minus current liabilities, or you have to add fixed assets plus the working capital. So return on earnings, NPAT, net profit after tax minus preferred dividend. Return on equity is equity. We are talking about the equity. So we'll ignore the preference here. Preference dividend, preference share kind of things, okay? Divided by net worth and divided by equity share fund into 100. There you will get the return on equity. Actually, this part is huge, so you have to bear with me. The next part is profitability divided by net profit margin will be equal to profit divided by net income divided by sales into sales divided by revenue. This is easy. Investment turnover or assets turnover. So as usual, turnover will be on the numerator and assets will be asset or investment or capital, whatever it is will be in the denominator. Then this is equity multiplier. That is same this thing, investment assets or capital divided by the shareholders equity. ROE is equal to return on equity is equal to profitability or the net profit margin into investments turnover or assets turnover or capital turnover into equity multiplier. Then EPS, earnings per share. This will be net profit available to equity shareholders divided by number of equity shares outstanding. This is DP, dividend payout ratio, dividend per equity share divided by earnings per share. Then price earning ratio, market price per share divided by earnings per share. Next is dividend and earning yield. So that is equal to dividend plus or minus. If the change in the price is negative, then you will use the negative. If it is positive, then we'll use the positive. Divided by initial share price into 100. Or DPS by MPS into 100. Dividend price per share, market price per share into 100. The next is earning. The next is earning yield. This is earnings per share divided by market price per share into 100. The next is market value or book value per share. So market value per share divided by book value per share, or average share price divided by net worth divided by number of equity shares. This is, or you can also use this formula: closing share price divided by net worth divided by number of equity shares. See, if they have given average share price, then you can use this. If not, you can substitute with the closing share price. Then the last one is Q ratio. Q ratio is equal to market value of equity and liability divided by estimated replacement cost of assets. So these are the profitability ratios. Thank you so much for watching. Please like, share and subscribe to my channel. Hit the bell icon and you will be automatically updated with new videos. Don't forget to watch my other videos regarding costing and FM.